I'm going to kick off because we're going to talk a little bit about interest rates, and that last panel had the perfect transition to our panel. So I want to build on that, and I want to ask an audience participation question. We'll talk about inflation. How many of you think the war in Ukraine caused inflation? How many of you think that the supply chain issues that have now been resolved caused inflation? How many people think that the Fed printing $2 trillion of new money might have caused inflation? Right. So I don't know why nobody's talking about it, but it's pretty simple math. I remember from my undergrad, money supply, right? You increase money supply, guess what's going to happen? People have more money. Guess what they're going to do? They spend it. How many of you now think that the Fed, by raising interest rates, will act to soak up that extra money supply? I don't see any hands at all. But the Fed believes what they're doing is going to help control inflation. I don't think any of us actually believe it's going to work. So you play that out. What's going to happen next? And the people that I talk to that are smarter than me, and we have this conversation, and they say, what's going to happen next? They say interest rates are going to continue to go up. So the last couple panels where they said, hey, they might come back down, I don't believe that. And from you all not raising your hands, I don't think you believe it either, because the Fed doesn't have the tool that it takes to undo what it did during the pandemic. They gave too much money away to too many people, and there's too much cash in the system now. And the Fed is going to just continue to raise interest rates. So those of you that lived through the 80s, that saw 14, 15, 20% interest rates, that's not off the table. It may cap out at a prime of 10, but that 10 is likely. Higher than that is not off the table. So when you get to that last panel and somebody says, should I sell now or should I refinance now, you might want to seriously think about the logic of today could be better than a year from now. So I brought all that up because when I talked to this smart group of people, a lot of these people were on this panel 2 years ago and a year ago, right? And we all sat here. And in fact, that same event we had in Chicago, we had a year ago with a very smart economist from one of the largest banks in the country. And he said, we think the Fed will raise interest rates two times at a quarter basis point each. And then we had this event a few months later, and we all said, well, interest rates might go up a point or two. Nobody thought we would be sitting here today where we're at. So I'm glad you all came today. This is a record turnout for this event for capital markets. And you're looking around the room saying, well, there's almost 100 people online. So all told, we have 300 people. The most we've ever had is like 225 for this event, something like that. So I think people are here because we need to know what's going on. We need the information that these people have, and they promised me they would give it to you. So I'll stop talking and start interviewing, but I'm just going to go down the line, let them introduce themselves, and just a quick intro about what you do, and then we'll dig into the questions, okay? So no funny stories, we'll get to those. Patty, we'll start with you. Make sure to speak into the mic for those 100 people.
Good morning. I'm Patty Gnetz, Senior Vice President at U.S. Bank in the commercial real estate banking area. Primarily focusing on construction and development financing, however, provide a wide array of financing.
My name is Ross Dahlin. I'm with First Bank and Trust. We're a community bank based out of Brookings, South Dakota. Have a large presence here in the Twin Cities. The bank's been around for over 100 years, so we're the largest privately owned bank based in the state of South Dakota. Do all kinds of lending, commercial real estate primarily, but we've really grown our SBA lending group as well.
My name is Wozniczka. I'm the Director of Commercial Real Estate with Bremer Bank. Once again, we finance all commercial real estate asset types, from construction to mini perm.
I'm Marcia Goff. I'm with Merchants Capital. Our parent company is Merchants Bank of Indiana, and I focus solely on multifamily, different aspects. And we do construction, bridge, anything bank financing related to help leverage up the GSE private placement HUD executions.
And I'm Tony Ferraro with Bridgewater Bank, Managing Director. Carry a pretty diverse portfolio of commercial real estate and then just general commercial lending as well.
Bali, Kumar, Chief Operating Officer of Pace Loan Group. We write PACE loans, and we write them across all commercial classes and across the nation.
So Good Group, it's a spectrum of lenders. For the uninitiated, this is a very sophisticated crowd. I don't feel like I have to bring you guys up from the third grade level, but just in case in the room you're newer-ish, most of these bankers do initial construction loans or mini perms. They're involved on the front end of deals when things are getting penciled out and when they're initially getting financed through the new construction, sometimes acquisition. The panel that went first this morning does the perm debt, so stabilized properties after they've been built. So we're going to talk about the construction market and the new things that are happening, what developers are doing, what banks are doing to service those developers, and then those developments that are in progress or recently closed. That's the focus of this panel. For those of you that are online, I did bring my laptop up here, and I do have access to the chat room. So if you have questions and you want to punch it in the chat room, I can see real time. And audience live, if you want to ask a question in the middle of something, just raise your hand. I really prefer like a boardroom style discussion, so feel free to just interrupt and ask, and let's build off of each other. So we're going to start from happy place, start with Patty and work our way left, and just talk about deals that are getting done. We know that there's a demand out there for housing. We know there's a demand out there for industrial properties. Even though interest rates are tricky and the capital markets are tricky right now, there are still deals that have to pencil out and have to get done. So let's talk about what is getting done, what's approved, what's the outlook for borrowers, and what's the type of person and type of property that's getting a loan today. Go ahead.
At US,
I think you're good.
okay. At US Bank, we have, overall, we've been very busy in a recent acquisition of the Union Bank out of California. So the whole bank wide, we've been focused on that acquisition, which happened at year end. But locally here, we have been providing construction financing on multifamily apartments and industrial properties. We've closed a few spec industrial deals with obviously relationship borrowers. We are recourse lenders. But the recourse can run anywhere from, say, 10% or a springing recourse or up to 100% recourse. Definitely a relationship lending platform. I see the biggest difference is obviously the indexes. We index our loans. We're floating rate debt. We can do any type of capital interest rate derivative, but we're floating rate debt, and we base off of SOFR. And last year at this time, March 1st, it was 22 basis points, and yesterday it was 4.65. So we see a big difference in the projections on construction loans for interest rate, interest reserves, and things such as that. And that makes a big difference. So deals are changing primarily by this index. Now, you've talked about how that changed, and none of us projected that. Ross was talking about that earlier. We didn't project this from last year, but that's the biggest difference, and it's tougher to underwrite the transactions due to that.
So it's not just rate and cap rate or debt service coverage ratio, the reserves are an issue too?
Well, you still need to have interest reserves, and you're using a different index.
Yeah.
So you're, the spreads, I think, are exactly what they were a year ago, 2 years ago. They're 2.5 to 3.5, depending on the risk tolerance. But the index is different. So we're talking about a 7% rate today. And then you still have to plan for additional interest rate increase. So the interest rate reserves of last year were based off of 4 and 5%. Today they're based off of 8 and 9%. That's a different part of your development budget.
Does anybody have a different take on that or looking at it differently?
I would just give one example of what Patty is describing. We had a multifamily project that was a construction loan that came online the last 12 months. It leased up right to our EGI projections, and the NOI is actually above where we are underwriting it to. But the debt service coverage on it is below a 1-to-1, even at a 95% occupancy. And so just a real-time example of the impact of that index that it's having on our properties.
What about down at the end, Bali? What are you seeing for new deals getting done today?
I mean, I'll echo just the general concept that DSCR is everything, right? Like a year or two ago, we were looking at cap stacks and we were basically just like juicing the last dollar. We were pushing, we were seeing the senior come in at 70, 75%, and we could throw on another 10, maybe 15%, depending on the deal. But now everything is just DSCR based. So what does the senior debt look like? You know, if it's a debt fund and their interest rate is higher than ours, how can we blend the cost of capital down? How can we ensure that when we package all the debt together, that we can meet the minimum DSCR threshold?
You know, so I said we focus primarily on multifamily. And so for the construction side, we're always trying, obviously the banks are looking at their exit, what's the risk, and then you have to stress it. So our bank, we actually will do the forward loans in conjunction with a private placement forward for a 4% LIHTC deal. We'll also do it with the GSE executions. We are doing non-LIHTC deal forwards as well. Fannie and Freddie have a forward product now for that. And so when you can combine the forward product with the construction loan, one, we can increase the leverage on the construction loan because we have that exit takeout. We're locking in the interest rate today for the takeout in 24, 30, 36 months. So that's a huge advantage because if we had to underwrite the construction loan by itself, you would have a lower construction loan and need to bring more equity into the transaction. So we're definitely utilizing those together. I will agree with what Patty says. We get asked every day, I get asked if we can do fixed rate construction loans. And, you know, right now you can fix it with a hedge or a cap, but that's very expensive. But the impact really, if we have the perm commitment that we're doing at the same time, but we do see the source and uses, and it's the construction interest reserve is very, it is expensive because again, we're variable rate over SOFR, and we end up stressing the construction. I actually started looking at that analysis in detail. A year ago, I didn't care because it wasn't a big deal, but we stress that interest rate. Did I lose? We stress that interest rate basically every 3 months during the construction, during the underwriting to see what that reserve will be. So we have enough because we just don't know where SOFR is going to go. And it, again, as Patty said, it's very expensive today. I'm waiting for SOFR to peak so we start going down with that 30-day average, but that has not yet happened.
And just to tack on to the idea of a hedge, right? Purchasing a hedge is expensive. And what I'm seeing a lot of our borrowers do is use PACE as sort of a partial hedge because PACE financing is fixed rate. So there's a way to play with it and be creative.
We should do a quick poll. How many people are unfamiliar with PACE? Do you want to do a quick primer on it? Okay, there's a few hands that went up. So go ahead. This is your chance to do a short commercial. What is a PACE loan?
All right, so PACE financing, it's basically commercial real estate financing. It's based on the Property Assessed Clean Energy Act. But basically anybody who's building a building will qualify for PACE financing because nobody's building to like absolute dirt bottom code. And so you'll qualify for PACE financing. It'll only be in Minnesota up to 20% LTV. And it's just sort of fixed rate up to 20-year financing.
And it's paid back a little differently, right? It's assessed to the properties.
And so it's not a loan. I mean, we call it loans, right? It's not a mortgage. It is a special assessment to property tax. So it gets paid back actually as a line item on the property tax bill.
So again, for the uninitiated, if you own an office building with a lot of different tenants, can you pass some of those costs back to your tenants?
You can. I mean, everything's a dance, everything's a negotiation. So, yes. Sometimes you just pass the entire thing back through the.
Yeah, we got a couple questions here.
We had looked at a deal, and my impression was our bank relationship didn't care for it because the person maybe was a little lower than it.
Mark's question was for the people online. My bank freaked out when I brought up PACE, and I think that's changed. And when I asked that same question to these people, I got a different answer. So go ahead and what do you all think of PACE? Be nice, no knives.
I mean, we'll take a look at PACE. I don't know that we've done a lot of deals with PACE in it, but it's something that, kind of, you have to look at the whole deal entirely. And yes, there's a first lien on the real estate, but if you have a strong borrowing group, you have a strong property, strong location, that'll offset, that risk.
So
Yeah, fire away.
Is the PACE loan first position, or is the first position lender?
Great question. The question was what order,
Who's in the first position?
who's in the first position?
PACE.
property taxes are in first position, but the entire PACE loan is never in first position. So it's only the currently due and payable amount.
It's like real estate taxes. Technically, real estate taxes take a first lien position, and that's why you have lenders escrow for real estate taxes. So part of the way to mitigate that risk with PACE is that you escrow. You're always escrowing for any sort of payment, and so if there's a problem, then you basically can pay just like real estate taxes.
Does PACE stay there once it sells as well?
It can, then it sort of ends up being a bit of a business deal of like, if I buy the property, am I gonna make you pay off the PACE? Maybe, maybe not. I mean, if I'm inheriting 5% money from like a deal done 3 years ago, then maybe you keep it, but maybe you just make somebody pay it off.
Gotcha.
I get the feeling, Bali, listening to you talk, you've negotiated a lot of deals. It's not the smooth cookie cutter kind of thing. It's something you bring in when you need to get creative, and it helps, it's accretive to the deal, right?
Yeah, and I think, PACE doesn't work on every deal, but when it works wonderfully. So it's always worth talking about it.
Okay, I don't want to spend the whole time on PACE, but if you have more questions, he'll be up here. I think it's a great tool, great product, and we're going to talk about where it fits into the market today in a little bit. So let's do this. Let's do a little bit more participation with the audience and all of you. So all of the bankers on the panel, if this was your, I'm doing a visual for those of you who can't see me. If this was your loan volume last year, what's your loan volume right now? And I'm just going to bring my hands in, and when I get to where you're at, you let me know. Anybody? Anybody? Anybody getting? For those of you that. Okay, my hands are about to touch. Somebody say something. It's not looking good. All right, let's do the same thing on interest rate movements. Let's do one more audience participation. You're all smiling and laughing. How many people think interest rates are going to go up? Let's do a little scale. More than 2%. Let's just use prime because that's an easy number. How many think prime is going to go up more than 2% in the next, let's say, year or 2 years? I didn't convince a lot of people about inflation, did I? All right, between 0 and 2%, but it's going to go up. All right, it's going to go down, but less than 2% down. And then how many people think the bottom is going to drop out? This will be interesting because there is a possible scenario out there where the Fed wakes up and realizes they went too far and they killed the economy in a different way, but there's still all this cash out there and they're going to be confused and not know what to do. And a lot of people go out of business and a lot of people individually are filing bankruptcy. People are defaulting on their car loans. What's happening? What did we do wrong? And then they lower interest rates again. We could end up in a really weird situation. I'm not smart enough to go there, but it could get bizarre if rates have to drop. All right, moving on. So we don't know where interest rates are going to go, but consensus is they're going to go a little bit up. What are you all underwriting? You mentioned it, Patty, but does anybody else want to talk about what you're underwriting for interest rate increases?
Well, I can take that. We're doing a lot of new construction deals right now. We're working with syndicates as well. Typically what we're seeing is taking, 10-year treasury plus 200 or FHLB plus 200 just to get sustainable underwriting model that we can, work with. I've probably worked with 5 to 10 banks on syndicate deals right now, and I'd say everyone's within 20 basis points of kind of that underwriting rate right now. So if you look at that, what does that rate mean on a whole level? It's 6.5 to 6.75 is kind of that underwriting rate on new construction deals is what I'm seeing in the market.
I would say that rate is similar to what we're looking at too. We're still fixing rates for new construction on anything that's not multifamily, hotels, or senior housing. So we're really we've had a great run on multifamily, done a lot of fixed rate construction lending. Now we're at capacity on that, so our appetite is more limited. And if we do those deals, they're going to be at floating rate and maybe based off of a prime. So we're kind of shifting our focus and doing a lot of build to suit, some industrial, SBA owner occupied type deals. So there's a lot of opportunities out there in the non-multifamily space, and that's where our focus is right now.
All right, I promise you we're going to get to the good stuff. I know what you all are thinking, and we're going to get there, but I'm going to stay positive just for another couple of minutes. On the bright side, we've seen construction costs maybe come back in line, or at least level off and maybe come back down. When you all are looking at your pro formas for development, is construction costs helping? And I'll just throw that out, softball. Anybody take it, wants to make a loan today? Tell us how great it is.
I honestly don't see a big decrease in construction costs. We're still seeing the deals struggle, especially with the need for gap financing. Now, maybe construction costs have stabilized a bit, but you're not getting the significant changes that you were seeing every 3-6 months before you had your construction contract in place. But we definitely are not seeing where construction costs have filled the gap for gap financing. And so we continue to look for other resources. I've done deals where we have had ARP financing come into play as soft subordinate debt. We also do GP loans, et cetera. So we're always trying to get creative. That is probably taking longer on the front end to figure out that gap financing and how we can work with developers to achieve their needs. But I honestly don't see construction cost being at a point where that has come down and has filled the gap.
I agree.
Not quite there yet.
And
Hope?
a big part of that is land costs have not gone down yet. So we haven't seen, land options be traded back and forth. They're still being executed on, and until we see land prices go down, that's going to be the leading indicator on some of those construction costs.
Yeah, I would say a lot of deals that were supposed to close maybe fourth quarter or even, right now, they're being delayed. Borrowers or owners are trying to get better costs locked in. And, they say they're going to, but I haven't actually seen the numbers yet. So that tells me that the negotiations are still ongoing, and hopefully that'll offset some of the interest rate increases, but I know it's not going to fill the whole gap.
Yeah, we're seeing the same thing. You pretty much have to have, 40 to 50% down with these interest rates because the construction costs just haven't made up for it yet.
Thank you. I skipped over that. What is the borrower profile? How much is your equity requirement right now?
On a new construction multifamily, it's probably 40 to 50 to meet a 115 debt service at a 30-year AM and a 7% rate.
That's a change. Anybody any different? Any more high LTVs?
It gets right back to that debt service coverage. We just got a deal, multifamily construction, the Twin Cities approved this morning, and that was at 65% loan to cost, but there was more NOI being driven through that project. Typically, it's 35 to 40% minimum, and we have to hit that 120 on a debt service coverage on a 30-year AM. That's the challenge I think everyone up on this panel is facing today. We need the debt yield, that 9% debt yield that's kind of equating to a 120 debt service coverage right now with where interest rates are at. So, if you're generating more income in that property, you can get up to that 35%, but typically it's going to be, 35 to 40%, if not a little higher, depending on how much NOI has actually been driven through that property.
That's a good point. We live in Minnesota where we haven't seen the rent growth the southern markets got. I got to think if we were in Austin right now doing this event, people would be like, interested. I don't care, man. Rental rates just went up 25% last year. I'm just going to keep building because that'll offset a lot of pain, right? But our NOIs here aren't skyrocketing either, and our construction costs aren't coming down. That's the consensus. Okay. Development runway and pipeline. I promised we would talk about that a little bit. So it's another audience participation chance. How many people in here, raise your hand if you represent somebody or you yourself have a deal that you would do if interest rates were 2% lower and you could get 70% LTV? How many people have a deal in the works that you would do? Raise your hands high so everybody can see. So there's a lot of demand out there, right? Then that means there's real estate economics that make sense, but the financing doesn't make sense. Is that right? Nod if you agree. Up here, are you getting those phone calls from people?
I think they've slowed down. We were getting a lot of calls, but people kind of realize the math doesn't work and they're just pushing it down the road.
So we should have some pent up demand if we ever get into a good interest rate environment. Thoughts?
I think the rents are going to rise before interest rates drop. So all this pent up demand, these deals that are being delayed because you can't get financing right now, well, there's gonna be less supply out there, rents have to go up, right? So eventually the deal will work at those higher rents and higher interest rates. It's gonna take time.
Yeah, and the demand is also being determined by your equity partners out in the room here as well. So we've seen a number of projects that we've had approval on that, got, paused until, the equity partner wanted, they can go into treasuries right now and get the rate of return that they're looking for. So it's not just the bank that is driving that decision, it's the equity partners out there in the projects as well. We have had a couple of projects that were fully approved on the bank side, but ultimately were paused just based on the equity partners' interest right now of what return that they could generate, because our math is the same math that everyone in the room has here today. You start looking at, between break even cash flow to 115, we actually had a deal approved, a couple weeks ago that dropped us to just under a 115 debt service coverage. And there's not a lot of return, for the developer in that project as well. So, it's not just the banks that are being squeezed right now, it's, what the developer and what the equity partner wants for their return as well.
I like that point. All right, well, let's have some fun. This is the question that my contacts in this industry are asking is, where's all the REO properties? When does the fire sale start? So I'm going to lay the groundwork a little bit. We know that there are probably a lot of people in this room have a project ongoing or that just got completed that's waiting for perm debt. And we heard the perm debt panel say it's not what it was a year ago. So we know there's some inflection or pain point here happening. And these people are either trying to go to perm or get the construction loan off their books, or they're moving it down the road. So we're going to start with kind of just, what do you see on the getting out of a construction loan today? What does the market look like? And then I want to work into what kind of tools are you using to help people bridge this gap if we think interest rates are going to come back to reality. Maybe we'll just go down the road because everybody on here has a solution that I like.
A couple of weeks ago, I met with our special asset group, which is handles our other real estate, and asked what was the plan and what does it look like for us. We're a $700+ billion bank, so I figured it was a big number. And according to the head of our special asset group, we have the lowest amount of other real estate that we've had in 20 years. We're just not, we don't have it, which is good to hear. I said, are you planning ahead? Are you planning for our office portfolio to come to you? I mean, what are you planning? And not planning ahead for any big change in our other real estate, that we're going to own any of the real estate. So I think that, which we have done, being a relationship bank, we're working with our clients. A lot of our construction loans have extensions within them. Some of the projects work with the extension terms, some don't. But we'll work with the client in order to extend and give them a little bit more runway for interest rates to come back, for the permanent market to come back, for the sales market to come back, depending on their investment goals to achieve. So I don't think there's going to be a lot. At least there's not planned for that at US Bank.
Yeah, I would say the same thing. We have a very minimal amount of real estate owned. And, also there's not a lot of maturities coming up in 2023 for whatever reason. That's going to change. I think, right now we're kind of at a point where we just don't know what's going to look like, in 2024, 2025, when some of these construction loans that were originated the last couple of years are up for refinance and rates are still high. I think the conversation could be different in a year out. But right now, the ones that we do have coming due, we're gonna, we have good relationships with our clients. We're gonna work with them to keep that loan on the books and make it work. Now the challenge is, if rates are now 7%, you got to do a reset. Well, now the debt coverage doesn't work. What do? Do you put that property into default, or do you have an interest rate that gets you qualified as a special asset? So there's a balancing act to work, and we got to figure out how to move forward. So right now there's not a lot of REO out there, and hopefully that stays the same, stays that way. But you never know what's going to happen a year out.
Yeah, for Bremer, I see very little to no real estate owned, coming in the portfolio. I gave a presentation to our board of directors at Bremer last month to discuss this very topic. And how I qualified it was when we were going into the Great Recession, we had loan loss risk. Now we have loan default risk. This industry has been really well capitalized the last 10 years as these loan costs have gone down. And in this market right now, properties are performing on the revenue side and the NOI side. So we have a lot more tools to work with as these properties are generating, good revenue, good NOI. It's just we might be tripping covenants now. That gives the banks a lot of ways to, work with our customers, find solutions, and move forward. So I see very, very little, if any, loan loss risk right now in our real estate owned in the near future.
Yeah, I would agree with what the panel has said. We don't see a lot of REO and REO properties. We do manage the maturing loans. Our maturing loans are basically bridge loans or construction loans. The vast majority of our construction loans already have that perm loan forward commitment, so we don't have any issues with that. And they are converting, and there's delivery thresholds with those conversion, there's a tolerance. But so we're seeing no really issues on that. We stopped doing market rate, 100% market rate loans a few years ago, because we thought there was a lot of risk in that area. We have some, and they have, we have an extension, and we have extensions built in. What we'll do is we'll work with the developer sponsor, and we'll take a look at what that exit is. We just we have a loan that we just extended for 2 years out to give it time to potentially burn off any concessions, because everybody says rates are going up, because really the concessions on that one tended to be a factor. And then also we stress the interest rate. But so that was obviously an interest-only loan. We extended it, and then we did, made it amortizing, so the loan payment would come down, and we looked at a full exit analysis on that. There was just some discussion if we need to do a curtailment of the UPB. We ended up not having to do a curtailment of the UPB. So again, each deal is very specific, and we start looking at a minimum 6 months in advance of that maturity date. So again, just work with your lender. I don't think anybody wants to own these properties. And again, the banks are they are flexible, and they're looking at different exit alternatives out there.
Yeah, I don't have a lot to add. I just echo what everyone else on the panel said. We've looked at our entire portfolio of loans that are either coming due or having rate resets. And the good news is most of them are in excess of a one-to-one debt service. They just might be missing covenant.
We'll have to start on your end next time. So you get, go ahead, Patty.
I think another point is where your money is from. So I primarily lend to a lot of my clients are private clients, private companies based here in Minnesota. But if they have an investor that has the majority of the money in, if, for instance, it's office, which is the big discussion, the big property type being discussed today, and there needs to be a large capital call in order to make the property work, and it's a non-recourse loan or a non-recourse construction loan, there is discussion if they're putting in good money after bad. So there are discussions being had in the public range with the funds and a lot of the public companies on whether they should chase it, because a lot of them, they own it in a pool, and so they look at the risk reward and where their money's going to be used, and maybe that asset will never, or the runway is too long. And so those discussions have come in the past 3 to 4 months that weren't a year ago. So I think it depends where your ownership is at.
So, and those could be non-recourse. So they may have the ability to just walk away.
Yes.
Well, let's talk solutions for these people that find themselves in a bind right now, whether it's covenants or whatever's going on. Yeah, and I see you're going to raise your hand because that's where we're going to get to. PACE is a solution. The one that's already been brought up, interest only. So you all are thinking, okay, can we go interest only? How can we do this? Marcia, you brought up a lot of good points. How do you work with that delta in the interim step? And that seems to be working. But how would, Bali, how would PACE fit in if you found yourself in a bind?
I saw it a lot in 2020, and I'm seeing it a lot again now. PACE being brought in as sort of rescue capital. If there were, PACE eligible things in a new construction project and the project's complete, you can look back and basically reimburse yourself. But then what happens with those proceeds, right? Like, let's say you cash out $3 million. We chat with the senior lenders. Maybe the senior lender says, all right, yeah, but you need to put, $1.5 million into some sort of reserve or pay down our senior or, something where we're all sort of working together to avoid default.
Does anybody have any questions on that part so far? Yeah, go ahead.
Are the regulators constraining what the banks are doing?
Ooh, very good question. How are your regulators, giving you the one eye, what's going on down there?
Bali and I were talking earlier, and you can look at this as a fun time to be in the industry, right? I mean, we're not doing 75% loans to 3.75% anymore all day long. We're being creative to try and get deals done, and we are getting deals done. But again, that's all in confines of the regulations. So that's where the gray area is a little bit. What those regulations are, it's always evolving, and it's important to find a bank that has a good relationship with the regulators, and that can allow that creativity to make the deals work.
From the regulator standpoint, they're requiring us to do stress testing in the portfolio, which, they're not restricting anything right now. It's just line of sight to what the stress testing looks like from an interest rate and maturity standpoint. But I think something was touched on this morning that is important from the regulator standpoint, and that's not all, capital is priced the same within a bank. So if we're missing covenants, if we're missing debt service, that's going to be risk rated appropriately within the bank. The bank has to then reserve a higher portion of that loan that's higher cost of capital. So are they directly, influencing us on, what we can do? No, they're not. But we are adjusting our risk ratings appropriately. And then that return, those loans have a higher cost of capital associated with them within the bank. So as we keep our portfolios true to the risk rating and how they're performing, that's a consideration to have as we start having higher watch list credits and everything, that the capital ratio on that changes.
Kind of a follow-on question. I remember in the Great Recession, right? There's a lot of talk about tier 1 capital at banks. How does that look today across the industry? Does anybody have any insight on what it is relative to some other point in time?
The question was over my head, but it referenced tier 1 capital and how the banks are indexing and looking at their current loan portfolio.
Here, I'll simplify. Where are tier 1 capital ratios today, industry-wide, relative to something like 2 years ago and something like the Great Recession?
So the question was, where are the ratios at in comparison to 2 years ago and in comparison to the recession?
Take it. Great Recession, we're way better today. We're worse than we were 6 months ago. And it's just because the runoff in deposits within banking as they're chasing those treasuries and everything. So it's not that our assets, our loans are in a terrible shape and we're having, to downgrade and reserve against it. It's just that there's a runoff in deposits across banks. And if you're sitting in the room, you want to know how your, bank's capital is doing, ask, are they giving me a $10 million loan and they want $5 million in deposits? That should answer your question for you. And that's getting the heart of the issue. So it is worsening, but it's worsening on the deposit side. And, that just overall, but we're far better off than we were in the recession.
Yeah, I was talking with a developer investor just a couple days ago who said his normal bank was out of money. That was the response they gave him. Is that what that means? There's not enough deposits, not enough reserves? Or were they just punting because they didn't like the borrower? I don't think he's in this room.
Yeah, I would say being well capitalized is different. That's different than having money to lend. Banks might be still relatively well capitalized, but that doesn't mean we can't use that money. We're restricted because it's tied up elsewhere.
Well, I also think one of the questions, and maybe this doesn't directly answer your question, but the spreads probably aren't as different as what you're seeing on the indexes are, because the indexes for SOFR or for, whatever the swaps that you're looking at, those spreads are incredible, or those indexes are very, very different than 2 years ago. And, spreads have, maybe they'll widen out a little bit depending on the risk profile. And also, again, each deal is different, but it's really the indexes, I think, that has really caused a lot of the short-term pain here. And obviously, we can't control those indexes.
And I think the government is, they're always watching. We feel like we're being watched all the time, but we're a fifth largest bank in the country. I think that, we have to do the risk rating of all of our loans. We look at it more closely than ever before. We need to have that right. We need to have our reserves right. It affects a lot. In the first panel of today, people talked about the securities that the banks invest in addition to their loan investments. And those securities all went to market at year end. That affected every bank. So there's a lot of factors. I mean, if you're interested in your bank and seeing how, we're all rated, so you can look at the bank's rating, they watch it all the time. And I think it's going to be different. We're currently going through an audit from the OCC, which is our annual audit. It's going to be different than last year. I mean, everything's different. They're going to look at the portfolio different. So we scrub it, and then we scrub it, and then we scrub it. But I think that, they'll look to make sure that we have enough reserves, so that our balance sheet remains strong. But Tier 1 capital at US Bank, we're watching it all the time. A year ago, we didn't talk about Tier 1 capital. We talk about it. Or at least I didn't talk about it a year ago. Now I talk about it.
Anybody online wants to ask a question? I've got that up right here, the chat room inside of our, to the right side of what you're watching. Okay, I'm going to pretend, we're going to go a little different direction here. We've got 17 minutes. I'm going to pretend I'm a borrower, and I'm walking in with my loan application and handing it to you all, and we're just going to go property type by property type, okay? And we're going to pretend I'm not super well capitalized, because that part is true. So I've got my apartment project. Who's in? Comments? Maybe.
I'd look at it.
Okay.
Lots of questions.
And by lots of questions, what do you mean?
Well, first of all, we're going to ask what type of product it is within the multifamily. Is it 100% market? Is there any AMI rent levels? Is there, you name it, we'll ask a ton of questions. And then, your experience. We definitely, if you're a new borrower, we're going to want to see your REO and financials up front at the quote stage. I know people don't like to provide that, but definitely the banks the credit side is asking for that for new borrowers. We want to see how the REO schedule looks like. If you're a new borrower that has limited experience, 100% market rate, purely speculative, obviously we would pass on that. So again, we're going to be asked, we do a lot of pre-screen, and then we try to find a product that fits with what you need. Again, whether it's a workforce housing forward, whether it's obviously if it's a LIHTC deal, that's much more complicated. There's very different players in that. But again, and obviously we'll look at market, but it's so much more than market. It is the developer's experience and then financials, et cetera.
So experience over market. If I said I'm going to go to downtown St. Paul and meddle with that, that's better if I'm a great borrower versus, getting a good suburban, 4-story easy building.
Yeah, we do a lot of upfront pre-screening, and we'll take a look at that market versus a suburban market. We've actually we'll take a look at the demand on it and then the exit. Again, as a bank on the construction side, we're always solving what's the exit, because we don't want these loans on our balance sheet.
Yeah, that's perfect. So on a pace, apartment buildings?
Yeah, we will look at market data, we'll look at your pro forma, and if the deal works, if a good deal works, a good deal works.
Okay, so I might have gotten funded. That's fun. I'll tell you a quick story. And you guys probably everybody in this room can relate. In 2004 was when I did my first CMBS loan where I was a borrower, and I was right out of law school, and my balance sheet had more debt on it than it had assets, and they didn't care. I was like, wow, something's wrong. Turned out something was wrong. Canary in the coal mine. Maybe you shouldn't have made that loan to me. But I don't think those days are ever coming back, right? We're scrutinizing, we're paying attention to what we're lending on, and that's a big part of the process. Okay, so I go back and I go out and find another deal, industrial. So I show up with an industrial deal. Who's in? Spec industrial. Yeah, so that just blows my mind, right? How many people think we're in a recession right now? One? The guy who's asking all the questions is the smart one. He thinks we're in a recession. Anybody else think we're actually in a recession? And we're talking about spec properties. That's pretty interesting to me, that we can do both at the same time. And maybe we're not in a recession. Maybe that's imaginary because there's just too much money. All right, so back, my industrial deal got funded, yay. I was presuming I brought the land at a good value, right? Because that's probably the constraint there, is finding stuff, good ingress, egress that you can afford. Okay, next up, I got a hotel. What are your thoughts?
I'll take this one because we're closing a hotel deal this week. Despite what we heard in the first panel this morning, my production budget is larger than the last 2 years. So we are open for business, and that includes hospitality, that includes office. You know, if the deal works for the borrower and for our underwriting, we'll be taking a look at it. So I hope to close a hotel deal this week that we've been working on for a couple months. But ultimately, it has to work from an underwriting and cash flow perspective for both the borrower and us as the lender. And if that works, we're open for business for taking a look at those assets.
And you'll be sitting up here after the panel to take business cards, because there's a lot of people just lit up in the room when you said office buildings. Okay, so industrial got funded, my hotel. Anybody else want to pass on a hotel or get after a hotel?
I mean, again, hotels, sometimes it just depends on where it is. So like, we're doing a few hotel deals and we lend nationwide. So like, there are just some areas that don't have enough hotels, or like are missing one or two good hotels, and all their hotel stock is like not very good. So we really scrutinize where the property is, what the property is going to be. There are definitely some diamonds in the rough out there. So I don't want people to feel like there are no deals getting done, because people have good deals.
Very selective lodging.
Yeah, I probably didn't get that deal funded, but more comments?
Well, I was gonna say on hospitality, if you look, so our RevPAR is over where 2019 levels were. The challenge with hospitality is the labor costs. That's the outsized impact going down to the NOI. So the revenue is working on a lot of hotels. It's just that, especially if you go to full service, the labor cost is what's really carrying down to the bottom line. But we're seeing a lot of improvement in our hotel, risk ratings internally. We had a lot in the pandemic, and I would say in the last 3 to 6 months, we're, a trailing 12 number is much better. But the revenues that hotels are generating is great. It's just, can they keep up with the cost of labor?
Yeah, Dave.
From an underwriting standpoint, then, are you looking just T12, or are you going to go back and look a little COVID and see what the hell?
Yeah, I mean, if we go back to,
Well, the question was for the people online, it was underwriting, right?
Yes.
And
T12, trailing 12,
Right.
or you can go back further just to see.
your historicals might not look super pretty.
Right,
Yeah.
I'm just curious.
How do we get around that?
Are you flattening out, trying to mold it?
I mean, we're underwriting based off the T12. We're looking back from 18 to see what it's doing pre-pandemic, what it did during the pandemic, but the underwriting's based on T12.
Sounds like a broker maybe trying to make a deal. Just guessing. Right there. Okay, so now I show up with my office building. Anybody at all doing anything out there? Do you see any volume? Do you hear any peeps? Are there things that make sense? Is it only like owner occupied? What's that market look like right now?
I would say if it's suburban and, on the smaller side, maybe, less than $30 million, we'll definitely take a hard look at that. And all these deals that you're bringing to us, the LTV is kind of the big wild card. Is it an 80% deal? And those deals might work if it's a retail build to suit. But if it's multifamily or hotel or something else, we're going to be a lot less.
Well, I drove a Ram truck here, not a Ferrari, so high LTV we're talking. Because I want to push it. I want to see where you guys come in at, right? Okay, so office building, it's not off the table completely? Do they have to be full? Do I have to have all my leases signed? Where do I got to be? Patty's being quiet. I don't want to see it.
I'm out.
Totally understood. All right, any other wild cards? What are you seeing that does get your interest? Self-storage interesting these days? I didn't talk about retail, big box, strip malls, shopping malls, redevelopments. Anything that's outside the normal box that might be interesting?
I'm gonna qualify my statement on office. I like life science office. So I'd be interested in life science. Of course, would love it leased versus spec, but I'd do a spec life science in the right location. So the traditional office, I'm not that interested, but life science, I'd be interested.
A good reason to have office. Just a quick poll, because we've been doing this forever now. How many people are back in the office? Let's go full-time, 5 days a week. This is a hardy, hardworking crowd. All right, how many people 100% working from home? That's interesting. Is that because we're finance people, do you think? Oh, hi. People working from home? Right, there's 100 of them. I'm glad you qualified that, Mark, because there are 100 people watching through that camera right now, and they're not going into the office, I'm guessing. It's a better event than your PJs, I gotta think. Well, at least you don't have a blue sport coat on. I can't make that joke and then pan around the room because there's 150 blue sport coats. Okay, any closing thoughts? We have 8 minutes left. What I always like to do is say, okay, people in the audience and people up here, is there something we didn't talk about that you would be bummed if you walked away and said, oh, I should have said that? Or somebody in the audience that says, oh, I should have asked that question. Now's your chance. You have 8 minutes and it's rapid fire time. So closing thoughts, and if I see a hand raised, I'm going to stop you. Let's go from the other end down this way. Closing thoughts.
I don't know. I don't want to beat a dead horse, but there are good deals out there. Like I'm seeing lots of deals. We're passing on a fair amount of deals, but like I'm still seeing that there are good deals out there to get done, and I want people to be heartened by that.
Yeah, I'd probably speak on the same line there. We're still actively looking for deals. I know people think that banks aren't looking at deals. We want to do deals. It's just kind of the math right now, but you know, if you have a good deal, bring it to us and we'll look at it.
Yeah, I agree. I think the first panel said this, and my partner says this all the time, math is math. And so when you're doing your pro forma, just make sure it's updated and it's current. Obviously, we'll help you with that. One of the things you said was when you bring in a deal, what do you look at? Well, obviously, the first thing I look at the pro forma and the data input assumptions. And if the interest rate is too low and you're LTV constrained, typically that deal is not going to work today. But there are a lot of good deals out there. And the other thing I would say is that there's tools out there that we haven't had to use for the past probably 10 years, and we're shaking off the dust off of those old tools. And I guess that's a good thing about being in the industry a long time, because you kind of look at different creativity that maybe we haven't had to look at in the past 10 years because there was a different market condition.
Yeah, for me, ultimately, you know, we're cash flow lenders. That's what we're looking at. I think just the number of deals in the market, as probably the next panel is going to discuss, is way down. When we're bidding on deals that are in the market, you know, if it was 7 banks bidding on it before, we're probably down to 2 or 3. So we see, you know, less competition, but there's still competition for most deals that we are bidding on. And we're open for business and want to be quoting deals as much as you want to be doing deals. So that's where we're at today.
Yeah, I would say in the last question for.
Oh, yeah.
Question for Marsha, what are her creative?
Yeah, that's a great question. I think we did a couple of them, interest only, more equity. What are some of the other ones?
Yeah, so what we'll do, again, like when we can do the forward rate lock, where we can then have the loan to cost be higher. So that's a creative tool. We talked to the borrower about different gap funds available. Again, working with a possibility, again, each deal is different, but if there's city government support, obviously we look heavily at tax abatements or tax exemptions. If you can do, the workforce housing, you only need 10% at 80% AMI, and the rest can be market. So if you can do a deal right now that's 10% AMI, it's only rent restrictions, and there's no income restrictions. And typically that does get paired up with some tax abatement or exemptions or soft subordinate debt. It just really depends on each deal. And then what we'll do is we'll do the construction loan with that, with the perm. We leverage things up, and then we try to also do the one-stop shop where we will, save on different fees, et cetera. So you're not doing third-party reports twice, you have a reduced legal fee. So there's different ways to look at it, but you got to look at it holistically all together. And then the other thing that we look at too is if you're, one of my first questions that I always ask on a new construction deal, I ask, is it 100% union wages or, prevailing wage? And if it is, then we have different investors that we can use to come in, and that can help basically subsidize the interest rate. So you can get a further interest rate reduction on the perm loan, which then in fact, you can support more loan dollars on the perm loan, which then means you can support more loan dollars on the construction side. So that's why I say I ask a lot of questions up front, just because there's different tools that we have to structure deals.
I would add to the tools, if someone brought me an A-B note structure, I'd look at it. If they want to amortize quicker on the B note or something of that sort, I'd be open to that. And then I think I look at deposits as a tool, not a necessity. If you want to bring deposits, then we can talk about lower interest rates would certainly help, those coverage ratios here as well.
So First Bank and Trust, we're a $4 billion size privately owned bank, and about $600 million of that is commercial loans based here in the Twin Cities. And we want to grow that to over $1 billion in 2 years. So deals are tougher to make sense these days, but at the same time, our growth plans, we're going to be doing deals. And we're not just going to be doing small SBA deals. We can't get to our growth plans by that. So there'll be a lot of commercial real estate coming on our books. And I would say our creative tool is just the fact that we're a privately owned institution. We have a lot of flexibility we don't answer to an investment group. We're willing to work with you to get the deal to work.
Closing thoughts, last chance. Any more questions? Well, when she's done, we'll get to you.
US Bank is definitely open for business. We're looking for new transactions. We love the Twin Cities. This is our headquarters, and we plan to stay here as our headquarters, which is nice to have the fifth largest bank be here. I think it's a time of creativity, both for the bank, for us to be creative, and for our borrowers to be creative. It's not the same transaction as last year, and probably not the same transaction as next year, but I think deals will be getting done. We do not require deposits. We're not telling our clients that you have to bring deposits in order to borrow from us. We're a very large bank. We get deposits from many different customers. And so we're open for business and we're looking for deals. So I'm cautiously optimistic. Again, I agree with my co-panelists. The deals are less. There's a lot of developers that are taking a pause for 3 months, 6 months, to just wait and see where everything is headed for 2023. And that's good. They have to be careful of their capital and their partners.
All right, here's the question.
Do you have, outside of multifamily, do you have the capability at all to tweak your amortization, push it from 25 to 27, 30? That gives you a 20% or dropping your coverage from 130 to 130.
So I heard the question, can we go to negative debt service coverage, higher LTVs and long AM, 40-year AM? I'm joking, but yeah, how much are we stretching the metrics here? And what's the room?
Regulated, or is it just internal constraint?
And is it regulated that you stick to those constraints, or are they internally placed by your board or whatever?
Self-inflicted. When the dam breaks, someone's going to go to 30.
Right.
Underwriting, or 32, or there's going to be some change to get that money out of it.
And then, and you prefaced all of it with outside of multifamily?
Yeah.
Okay.
Our constraints are internal.
Yeah, they're internal. It's always been a 115 minimum, but a 25-year AM.
We're 30 out of the box.
Yeah, same on industrial, I'll look at, 30-year amortization on it if the loan to cost and the cash flow supports it. We're also looking at spec industrial. I'm not looking at amortizations in that realm for that. So it depends on the property, but it's internally constrained, and we do that ability to go up to 30.
I heard
This could be fun. I just thought of a great idea. We're going to do bidding wars at next year. A whole new kind of
What's
event.
your amort on that 112? Math is math, right? Yeah.
We got a hand up.
Question piggyback. Can I average today's underwriting with the underwriting from 6 months?
Right. Yes. He wants to turn the clock back. Well, it doesn't tick backwards. I mean, if somebody can figure that out, some great scientist somewhere. Anything else before we close up? Anybody else have any parting questions? Did you get all your questions answered? Anybody in the room start a fund for debt, for distressed properties that's going to go home unhappy now? Oh, good. Maybe next year. We'll see what happens. All right. Well, thank you very much, this panel. These people will all stick around. Hopefully I'll be here too. We'll move on to our fourth and final panel. Again, we're going to go about 5 minutes over today, so 12:05. We'll get you out of here for CE purposes. Don't forget to sign out